and oil. We're still talking about it all today. Is the market paying attention to the right things? Let's bring in Lee Munson of Portfolio Wealth Advisors from Albuquerque, New Mexico. So Lee, what are you watching? I mean, Apple seems very important to sentiment right now. Do you agree?
Well, yeah, I mean, come on. I mean, this is the barometer for large cap U.S. tech stocks, as well as a barometer to how we feel about this bull market itself. And so when we start looking at Apple and saying, you know, why are we so concerned about it? You know, there's a couple big things. Number one, as far as sentiment is concerned, it's a problem. But I think you have to put it in its place. It's still a big tech company, and they're not able to tell, you know, we have this don't ask, don't tell on iPhone sales now, right? So we're putting that first nail in the coffin to this bull market. But I think this is more about the valuations of tech companies and people starting to realize, what are we gonna do next year? Like, how are we gonna get some growth and some revenue? And the more people panic about it, the more those shares go down. And I think it's a good purifying thing. I'm unconvinced, Jennifer, that we're gonna have this, you know, mopey market go into the new year. I think we're bottoming out here. I think we bottomed 2 weeks ago, and I think that we go higher and see a little Santa Claus rally, because there's more to the market than just iPhone sales, even though it hasn't felt like that for 6 or 7 years.
Hey Lee, Miles here. So talking about tech stocks more broadly, you said the only horror story is the valuation, not the revenue.
Yeah.
You were just kind of hinting at that with Apple, but maybe broaden it out to the other FAANG names. What exactly do you mean by that? What perhaps is the broader market signal to take away from that line of thinking?
Well, I mean, here's the thing. I mean, how are we supposed to even to look at Amazon and how we're going to value that company? I mean, it's just sort of a Ponzi game of taking over, taking over, taking over, taking over. You look at Facebook. Facebook's best days are in the past because now they have to play by actual rules. And this concept that Tim Cook himself brought up, that this data might belong to us, I think that really puts into question how lucrative Facebook's going to be going forward. I mean, God, this just seems like AOL Time Warner 2000 all over again. You look at something like a Tesla. Man, Tesla's not a tech company. They're just an overpriced car manufacturer that is relying on the kindness of junk bond markets. And then, you know, when you look at something like a Netflix, I mean, hey, I think Netflix is a great business model, but again, if we're relying on more and more expensive content versus midnight B movies to get people to sign up, I think we're going to start seeing some compression in those valuations. So anything large and anything that's been the big growth stuff, there's a law of large numbers. These can't just double and triple going forward without an exceptional amount of revenue and profit growth. And I think it's just going to be difficult going into next year. Again, these numbers aren't bad in and of itself. These are good companies that make billions of dollars, some of them billions in profit.
Yep.
But we can't assign a valuation in nosebleed territory going into next year.
Jennifer back here. You are not super bullish on tech right now, obviously, listening to you. And I emailed with you earlier to say, what's one chart we could pull up that Uncle Lee could teach us a little? And the chart that you had me put together is basically the Russell, small caps versus the S&P from 2000 through 2003. We're looking at it right now. What is it that you want investors to take away from this chart?
Okay, here's the thing how you look at this. Okay, when you're looking at the longer term, and not even longer term, but a 2 or 3 year drag on a major index like the S&P that's heavy in tech. So you have a bunch of valuation compression over a bearish recession that we had after the dot-com crash. Look at what's happening here. We've got a 40-point difference between the S&P 500. That's that solid blue line down there. It's mostly moving with small cap. You can see the squiggly lines are pretty much squiggling with everything else. But the difference is that you had that drag from Cisco Systems and Intel and Coca-Cola and JDS Uniphase and Corning, all those great names like the AOLs of the world. And that lingers for years and years. Why those big names, those FAANG stocks, I think is the analogy today, when those valuations crush, it could take several years for the index to recover. So why not go someplace where you don't see those big valuations? Again, you know, tide goes in, tide goes out, but down 23% over that period versus up 17, it's a huge difference in relative performance. And that's because you're starting off at a period of very high valuations in large US companies coming down to earth over years. So you can get hurt. You can get hurt in the S&P, you can get hurt in anything, but I think the NASDAQ has the risk.
So emerging markets fund manager Mark Mobius out this week saying that it's time to buy EM. I know that you have, already been in here. But what about the strong dollar? Don't these countries carry dollar-denominated debt? Are you not worried about it? Are you worried about oil here? Is it kind of too risky to put your toe into EM right now?
Here's the thing. The dollar's a problem. The dollar's why EM's down 20% this year. Right? Look at this. This is the best run that we've had on the US dollar. Is it now the second or best run since 1970? It's in the top 3 of big runs. So this is what's causing EM to crush, because people are concerned that with a rising dollar, the emerging market debt loads will become unsustainable. Man, I've been hearing this since 1980. This is not new. But I'll tell you what is interesting. The 3 things that were going to kill emerging markets is the dollar spike. Oh, that happened.
Yeah.
But then oil at 100, oil's not at 100. Believe me, oil's going down because it was jacked up 30% earlier this year on Venezuela and Iran, not because of actual demand. And then, the third thing is a so-called trade war. I say so-called trade war, so I got 2 out of the 3 things that were supposed to cause this bear market. I got bear market prices today, but 2 out of the 3 things is not happening. Oil's not at 100. And the so-called trade war, I don't buy it. So all we have is the dollar spike. That's not good enough. So if you see a bear market and you don't have all the things lined up for it, you be a contrarian and you buy it.
Sometimes 2/3 is good enough. Lee Munson joining us live from Albuquerque, New Mexico. Thank you so much.